Good evening, everybody. 90 degrees in Southern California. It's winter night here in Pittsburgh, and just was talking with John, and he said it's kind of pretty cold up there in Calgary. So tonight we've got the great pleasure of having Johnny Seville here with us, and he's going to go through what to do to be ready for the market pullback or the market crash. So with that, Johnny, good to have you here tonight. We're anxious to see your information.
Thank you so very much, mate. It's an absolute pleasure to be back, and it's always such a great group of students that that you work with. So I'm excited to share with you my thoughts on what's going on tonight, everybody. And so, as Stephen mentioned, I'm joining you tonight from cold Calgary, and you here on my slide, and hopefully you should see my my little screen. Just give me a quick one in the chat box, and we'll kick things off. Now, as you do that, again, as we mentioned, the topic for this evening is capturing the crash, how to profit from the market meltdown. So we're going to be talking about both sides of where things are going at the moment, and dive into the data that we look at to determine what's most likely to happen next, because no one has a crystal ball, but the data is what can give us probabilities of where things are going next. And for those of you that may have joined us last time we were on this show, we were presenting back on August 26th last year here in this room, and I talked about some of those data points. I'd be interested to know who was here with us that August evening a few months ago. Put a 3 in the chat box if you recall that presentation where we talked about some of these data points. If you weren't there, that's no problem, but we will be going over them again. And of course, it's fascinating to see how some of those data points we talked about back here in August have played out since then. So before we get into all of that, again, quick disclaimer, this is for educational purposes only. Acorn Wealth is not a financial advisor in any jurisdictional province, so today's presentation is purely for educational purposes only. Trading stocks and options involves risking any capital that you invest, so always be aware of the risks. Any stocks or options that we discuss may be being held by myself, the employees and contractors of Acorn Wealth and Smart Money Trading, or positions we may be getting into. Again, there are no guarantees with any financial investment, not real estate, not stocks, not futures, not options. I'm not going to make any silly guarantees to you tonight either. And of course, I've been doing this for a while, so let's assume my results are not typical, and any past returns discussed do not guarantee future results. So there we go. Let's jump on into things. So again, the topic of today is how to capture the crash and profit from a market meltdown. For those of you who typed in 3s, Peter, for example, welcome back. We've been doing this for about, 15 years now. We started in November of 2007, and we've trained about 5,800 students since then. The reason why I got into trading was to have systems. Because I got into trading because I wanted to travel, right? I wanted to be able to do something from anywhere in the world, whatever that was, whether it was an online business, whether it was trading, whether it was real estate. It had to be something I could take with me so that I could travel. Australians love traveling, as many of you probably know, and I certainly do. So, but the problem with my early strategies that I got into is that they were extremely time consuming. So I signed up for trading, 20 plus years ago because I wanted to have freedom of my time, but inevitably the strategies that I got lured into were very time intensive. And I had 6 screens in front of me and two televisions with the news going on all the time. And I had, felt like 30 different indicators that I was using. And worse, I wasn't making any money. I was spending all day long having an anxiety attack and losing money for the privilege. So that was my biggest struggles early on for those first 2 years, was total analysis paralysis and just having too much and spending way too much time. Again, put a 1 in the chat box if you've experienced that in your journey. I think everyone has. And so one of the game changers for me was meeting my mentor in Vancouver about 19 years ago. He's passed on now, but he was a great friend. He was one of the founders of Acorn. But before Acorn and before all of this, he was a good friend of mine and said to me, Johnny, you got to get rid of all this clutter. He said, you know, the big money out there is not looking at fancy indicators and magic beans. They're looking at price action, right? So one of the big aha moments for me was to get rid of all the magic beans and the bright shiny objects and come back to what really mattered most, which is understanding price action. Above all, for me, that was the most important thing. And secondly, understanding how to track what the big money was doing, what the smart money was doing. Because I realized early on it's very difficult to outsmart the smart money. And it's a lot more effort as well than following the research that's already been done for us by others that are in the know. And so this was I guess the kind of big game changes for me of going from chasing the bright shiny objects and always feeling like that success was just out of my reach to tracking what really mattered and what really made the biggest impact on the needle. And so this is where the idea of smart money trading came from, was to try and to simplify things while remaining sophisticated, if that makes sense, right? So doubling down on the smart money, what is this? Well, before we get into the insiders and some of the other aspects that we're going to talk about, what I wanted to start off by talking about was one of the smartest types of money that is out there. That's the bond market. Just remember, the bond market is substantially larger than the stock market. The stock market is where you go to buy and sell equities. The bond market is where you go to buy and sell debt. And the bond market is much larger than the stock market, the worldwide bond market. And it is a great indication of what that really smart money is doing when you're looking in certain places. So I'm not so interested in tracking the 10-year treasuries and 2-year treasuries. In fact, when I started out trading, I thought bonds were a type of underwear. And for those of you who maybe have spent some time in Australia might get that joke. But bonds were a foreign thing. So you don't need to understand the full concept of bonds to use what I'm about to show you. But what I'm about to show you is very important, and it's been one of the leading indicators or systems that we've used to predict major market reversals in 2015 twice, 2018 twice, the 2020 crash, and what's happened recently. In all of these situations, in all those big market calls we made predicting a sizable drop may be coming, this was one large component of it. So this ties back to what I was saying earlier, following the data, following the smart money. And so let's start by looking at how this indicator or this system gave us the heads up to a problem brewing, if we can put it that way, in 2020 or 2019 leading up to 2020. So when we have a look at the high yield bonds chart, and that's what we're looking at here. The symbol, by the way, is HYG, Hotel Yankee Golf. HYG. Now, when you look at the chart of 2019, what you'll notice is that the way that it moves up the screen is back and forth in what's called oscillation. In other words, this is where the system that's in control, or dare I say the pattern that's in charge, the algorithm behind the chart that's behind this, right, is buying and selling at these two very clearly defined points. And this is often when you know that something is in oscillation, where it's not really obeying the moving averages as much. It's more cleanly bouncing between these oscillating limits. And so when you see that, when you draw that on, it becomes clear to you that you see something is in an oscillating pattern. The next obvious question to ask then is, well, what shape is that pattern, right? And that's going to tell you how to treat it. Now, when we see that we have an upward channel, two parallel lines, or if we were to see that we had kind of two lines pointing up and pointing together, like a pizza shape pointing up, both those patterns are leading indicators that suggest that a drop may be about to come. And the simple tool we use then is we measure the distance from the top of the channel to the bottom, and we drag that down to beneath that, and that becomes our target of where the first bearish target would be if that when and if that breaks down. So now I'm sure that's maybe not new to you, but to take it one step further, when that will typically break down is often after 3 touches along support. And in the case of 2019, it actually touched once, twice, 3 times, 4 times. So in our mind at that point it was overdue. And so this was why in 2019, before we knew anything about the coronavirus, we thought trouble is coming. We don't know why yet, but we see that a pullback at least was due. And that gave us enough of a warning to get out of the way and cash in our longs and start taking some speculative shorts as we went into the end of 2019. Later we found out what the catalyst was going to be. But before I move on, does that make sense so far? I just want to make sure I'm explaining that clearly enough. And thank you, Peter and John. Glad you're enjoying it. Yeah, so just give me a 1 if that's all making sense and my Australian accent is clear enough. Okay, great. Yes, 1. Terrific. Okay. So let's move on to the next part. Obviously, what happened in 2020 is we did break down. We did hit that channel target. And then we rallied back up. And before, sorry, let me back up a second. We dropped down. We hit that target. And then the bearish pattern was over. Right? The bearish pattern that had been building since May of 2019 ended in March of 2020. And then came the big question. What's next? We don't have a bullish pattern. We've just reached the end of a bearish pattern and we're bouncing off that support and retesting that resistance. So the big question then was what comes next? And what happened there was, of course, we retested off that resistance and failed very, very sharply. And that continued down, down, down in this very sharp momentum-based drop. And that was when the moving averages took over and just pushed it all the way down to those significant lows we saw, and the market followed. Now, when I came on to the show last year on August 26th, I think it was, this was one of the charts that I'd shared with you all who were here. And of course, this again is high yield bonds. And this is the chart of high yield bonds that had been evolving from June all the way through to the end of July of so June 2020 through to July of last year. And for those of you that are here, you might remember me say that I felt that this was the most dangerous pattern in the entire stock market, right? Because what this told us was that the bond market had been building this bearish pattern for over a year, and it had just broken down through that key support for the first time since July 2020. And what that told us was that the high yield bond market, the really smart money, was dumping, was getting out. This tells us that they're avoiding risk. They're getting out of high yield corporate junk bonds, and they're saying, let's go to safety. And when the bond market is flooding to safety while the market continues to go higher, that once again is a very clear warning signal that's saying, get out of the way of trouble. We don't know how bad it will be, but something has really got the bond market spooked about the stock market and about corporate America and its ability to pay back debt. And as you can see, what's happened since that August prediction, that August data, the better way to put it, is we've gone straight down. So as of about a week ago, you'll see that we hit that 84 target, that target that had been being built towards over all of these previous months, and that 84 target was hit. Okay. So just like 2020, this was to me, this was the first time in 6 months that I felt that a genuine bullish trend could happen, right? Because in my mind, while the market was still having this big bearish, very high probability pattern, the rising wedge, while that was hanging over its head this whole time, saying, you haven't reached the 84 target yet, you haven't reached the 84 target yet, you haven't reached the 84 target yet. This whole time, since August of last year, we've been treating any rallies in the market with, I think as Stephen was chatting about before this evening, treating it with suspicion. Because we've talked about it in our trading room, being very cautiously optimistic. Plan for the worst, hope for the best, right? But basically always keeping risk and capital preservation at the forefront of any decision. And so my point here is that when we ran down and hit that 84 target, that was the first time in a long time that you didn't have a macro bearish pattern hanging over the market from this high yield bond indicator standpoint. All right, and where do you measure from? You basically take the widest part of the way I measure it anyway, is I take the widest part after you've had a test of resistance, a test of support. Once you've had two touches, measure from there, perpendicular basically in the wedge, and then extract it and duplicate it over to the breakdown point. And once again, you very similar to the way measure a channel. And that is basically where that 84 target came from. Because as soon as we broke down from that rising wedge, this showed us the distance that it should drop to. Does that make sense? AH and Jim C? Does the 84 target now make sense? Yeah, okay. You'll see it's pretty fascinating stuff. It's the same same reason, pardon me, it's the same reason that we shorted the NASDAQ, right? If you take a look at the QQQs in this same time frame, you'll see that the QQQs were in an upward channel. And again, an upward channel being a bearish pattern. And when the QQQs started to roll over at the end of last year, and we saw this head and shoulder develop, this head and shoulder pattern, same kind of thing. This had a target down here of, let me just make this a bit cleaner for you. Okay. When we saw the head and shoulder, we measured what we felt was likely to become a head and shoulder forming, and dropped that beneath. That gave us a target of 344 on the QQQs or the NASDAQ. And then we also measured the rising channel, sorry, and dropped that beneath the channel. And that gave us approximately the same target. So all these things were lining up in a perfect storm. You had this very bearish pattern in high yield bonds. You had a bearish pattern on the QQQs. You had a head and shoulders inside that bearish pattern on the QQQs. So as we went into the beginning of this year, you know, all of the patterns were all lining up to say there's a very high probability short-term drop in the NASDAQ, the S&P, and all of that, dare I say the words, all that easy money, that really high probability trade, all of that came to an end when we hit that target on the NASDAQ, right? When the high yield bonds hit that 84. That was when the first really big question to me arose of, right, if the bulls were to fight back here, this is where they have to do it. Because this is the first time that all those bearish patterns came to an end. So is that making sense, guys? So the importance of where we're at right now to me is critical. The words critical get overused, right, in almost every single marketing email you'll ever get. The critical thing you have to watch now. But I genuinely feel we are at a critical time. because these patterns, these systems have been years in the making, and now is the test. And the importance of what happened in the last few days is what really worries me about that test. And someone just already indicated it, Ronald. Thank you. Exactly. We broke further than 84. If you look at the way that high yield bonds are declining, we are not in oscillation. Momentum has taken control, right? You can see that this isn't bouncing between two straight lines. This is being driven down by your T line. You're moving. I think I'm using that terminology correctly. Feel free to correct me if I'm wrong. But your 8-day or your 9-day exponential, I use the 9-day, but 9-day exponential moving average, it's holding high yield bonds down amazingly well, and that is what really worries me about this. So that's part one. I spent way longer than I expected to on that part of the talk, but that to me is one of the most powerful smart money systems or leading indicators that I've saved my bacon so many times in the 2015, 2018, 2020, and most recently the 2022 correction so far. So I'm going to move on to the next part, but if that's all made sense and that's as fascinating to you as it is to me, let me know in the chat box, because again, I'm really passionate about these systems because it's data. Right? We're not listening to stories or opinions. We're reading what the data says next, and using that to lean our probability in our favor of what could be the next best trade to take or not take. The next part to this is insiders. So again, on the theme of insiders and smart money, right? Letting the hard work be done for us. And this is where kind of a sharp lesson for me in my early days came about. Long story short, when I was first starting to make money in my trading, I was sitting in a bar in Vancouver, and I overheard. Look, these guys were wearing blue Armani shiny suits and had the Rolexes and the champagne out, and I thought, wow, this is the picture of money, right? I want to cozy up to these guys and see what they're all about. And they pulled me in and told me all about their amazing company and how well they were doing, and I said, well, I guess I found my ticket to ride. Guys, this is so exciting. I'm so glad fate brought us together. What's the chances a new trader would be sitting next to the next Microsoft? How much money should I put into your company, guys? And they said, well, how much would you want to put into a company that would go up 1,000%? And, full of naivety, I went home and put my entire trading account that I'd been working on building for that whole year, applying my rules, applying my systems, applying my risk management, threw it out the window in a hot minute and put my entire account into this stock, and it went straight down, went to zero almost. I sold at about 5 cents or something, wiped out and blew up my account. And the lesson that I learned here was a bitter one, but it was worth it. And I'm glad I learned it early, because when I went to look at this company in more depth after I'd already lost all my money, I found out that the CEO and the insiders, these guys, had been dumping their stock in the open market when I was buying it. So I literally could very well have been buying their Rolexes, their champagne, their suits. And so this was a very sharp lesson, and a lesson that cost me dearly, but a lesson that I vowed to never make that same mistake again. Fast forward from this occasion, I again had rebuilt my portfolio again, all right, and gone back to my rules. But this is where we really started, where I really started thinking about what had happened there, and how powerful that knowledge of the insiders would have been to me had I have known it before I bought the stock. And so this became a key part of my strategy going forward, and not only just how we look for individual trades, but also how we look at the market. And so let's come back to looking at market conditions as a whole for a moment and talk about the 2020 crash once more. right? We looked at how high yield bonds played a critical, there's that word again, it was a very critical role in predicting, and better word, anticipating where things were likely to get heated and how bad it could get. But another smart money tool or indicator that we use to get an idea of what might be likely coming next was to look at the insiders. And when you see, I see some questions about bonds, so I will come back to that in a moment. So when you looked at the kind of emotional reactions to any market mayhem, I mean, it's really, I love to go and screenshot the headlines in FinViz. You know, market rallies. What do the headlines say? Investors shrug off inflation. Inflation woes subside as investors eye up great buying opportunities. Chief strategist from ABC Securities said that he sees another 5-year boom market, and here's the reasons why. Then the next day the market tanks, and of course it's renewed fears of inflation rocks the market. You know, one day the biggest market cap loss in US history as Facebook plummets. Next day, biggest market cap gain in US history. I mean, you can do yourself crazy following the news, right? And through all of that, there was data telling us what the truth maybe really was. Right? Through all of this news, if we get rid of the emotionally charged headlines, that's what all of this is about. It's about being able to find the data we need to make educated decisions. And when we looked at the data from an insider's perspective in 2020, what we saw was a very heavy bias towards the insider selling. Insiders were selling a lot. And it was also to do with the ratio of not just the fact that we're selling $13 billion of stock, because that's not a lot. It was the fact that the ratio at which they were selling versus buying at. So in the 2020 crash, in the months leading up to that, there was about $13.5 billion worth of selling and hardly any buying leading up to this event. And then when the market bottomed, this is more, perhaps even more important, even more amazing, was that they bought back. And they didn't just buy back a little bit. They bought back at levels that we hadn't seen since the bottoms of 2009. So this wasn't just gradually getting in either. They also loaded up in a concentrated time frame, which was about a week or two before the absolute lowest that the market got. So they loaded up in highly concentrated time frames with billions of dollars of their own money into their own companies, while the headlines were screaming bloody murder. So this was the number one reason that we thought a bottom had come into the market in April and March, but because of this insider activity. So this to me is fascinating, because it allows us to see beyond the headlines and to almost pick the brains by the best experts that there are. The bond market, right? This isn't your everyday trader. These are banks. These are institutions. This is big, smart money, right? We get to look at what the bond market knows, and we get to look at what the best experts know, which are the insiders of their own companies. They are the best experts, right? And so these experts were able to not only get out of the way of trouble well before many retail traders did, but they also got in very close to the absolute bottom, putting billions of dollars of their own money into their own stocks at the perfect time. So look, I have no doubt. I mean, because a lot of people say, look, is this fair? It doesn't really matter. Whether it's fair or not, whether it's rigged or not, it's just the way it is. So why not use it to your advantage? right? And we'll talk more about that in a moment, but I did want to just quickly address the question that had come in the audience about high yield bonds. So there was a question. I heard stocks and bonds move opposite. I wonder if high yield bonds move more with the stocks. So bonds typically move opposite to stocks, correct? But high yield bonds are different. So when the bond market says, right, I think that the stock market is healthy. I think that corporate America is going to have no problem paying back its debts. So to get a return on my money, what I'm going to do is I'm going to lend it to those companies. You know, when there's a new startup venture that wants to raise $100 million and they go out and want to raise money from the junk bond market, we'll give it to them. And we'll make a great interest rate for taking that risk. And so the big money, the smart money buys corporate junk bonds or high yield bonds, because that's a place they feel is a great place for their money because everything's going well and they make a return. When times of uncertainty or market meltdowns, crashes, corrections, whatever you want to call them, are very likely on the horizon, they say, I don't know, I don't want to lend money to Bob anymore. Yeah, I don't think Bob's going to pay us back. And so they sell those bonds, get out of those bonds, and then, of course, the price of HYG drops. And that's what you'll very often see is a bearish pattern or even just outright divergence when you're building towards a market top. So typically, the answer to your question directly is yes, high yield bonds normally correlate exactly with the market. Healthy market going up, high yield bonds go up. Market going down, high yield bonds going down. The trick to what you're looking for is when one doesn't match the other. When markets go up and high yield bonds are dropping, or when markets go up and there's a bearish pattern on HYG. That's when, in our experience, there's a very likely trouble around the next corner. And again, there's some great examples of that. I hope that answers your question. So let's go back to this idea of insiders as we drill down. And if that does make sense to those who are asking, give you a thumbs up or thank you, that's fine too. Okay. So let's dive deeper. We've talked about some of the smart money tools we use to track major market reversals and why I feel we are at a genuinely critical time in the market right now. But let's go further than that. Let's talk about then how do we profit from that? Well, of course, you can buy things like SQQQ or TZA. Those are leveraged ETFs that I'll often use in my larger investment account that I can't use for options and things like that. So if I'm taking advantage of a bearish market, those are some tools that I use. But what I really like to do is find individually very juicy shorts. It's the same way that I look for longs. Because insiders, as I mentioned before, are the real experts. They're not guessing, right? I respect till the end of the earth guys like Warren Buffett and Peter Lynch and so forth, George Soros. I mean, these guys are the stock market gods. But the real experts, when you're looking to buy company ABC, is not Warren Buffett. It's not anyone on television or in the paper. It's the CEO of company ABC. The best expert on that company is the CEO, the CFO, the insiders. They are the only true experts. And so everyone else is just making an educated guess, if you see what I mean. Insiders know what's going on. And the loophole that exists right now is known by the SEC. I was reading an article on it just the other day where even in one of their SEC documents, they talk about how there have been studies on how insiders are exploiting this loophole. So current rules basically allow executives to time their share sales or purchases to maximize gains. That was an article from Bloomberg last year, and here's another one from Reuters. Executives game the system. Talks about this loophole that exists. The loophole that exists is basically it allows insiders to buy and sell their own stock at opportunistic times by having some kind of a written plan. And in some cases, they might have 6 written plans, and they'll just cancel one or cancel the other or change it at a moment's notice, and can trade immediately after changing that plan. But as long as they put a plan in place originally, it gives them this freedom to be able to game the system. This Reuters article talks about it. Executives have been able to game the system, including engaging in de facto insider trading by creating, changing, and cancelling stock trading plans in secret and virtually at will. They are trying to close those loopholes, but it's going to be difficult. And I've read the suggestions that they're putting forward. It's going to be difficult. Will it rule it out? I doubt it. Might make it harder. But either way, as this article talks about, there will be a long runway before such rules changes take place. So this is a loophole that exists purely in the US. So it's a loophole that one gets to exploit mostly in US stocks. But insider buying or selling is something that I look for in any market that I trade, even if it's Canada or Australia. But especially in the US, because of that loophole, because we can piggyback off people that are able to, that may be possibly gaming the system. And I'm not pointing any fingers or naming any names, but I think it's a huge advantage that you have by being able to look at that type of thing. And when you start to look at, again, the insider selling at the end of 2021, this was around the June, July, August, September time when I took this screenshot, and it stayed pretty consistent through the end of the year. But there was a $40 billion worth of insider selling as we closed out the end of last year before we started to see all this volatility. And so high yield bonds, very smart money system. But here, another very, very useful smart money system where we're going to straight to the horse's mouth, so to speak. Because these, again, as I mentioned, these insiders know. They know about new product launches, drying up in this, what the supply chains are looking like, mergers and acquisitions, court cases resolved or ones coming up. If you're going long, you know, and you see a pharmaceutical company that's about to announce in the next 6 months the results of their pharmaceutical drug that they've been developing for years, and you see the chief medical officer buy $20 million worth of his own stock, you know, that's something I want to be looking at. And in the same sense, if a company was about to announce the results of their cancer-curing drug and the chief medical officer sells everything, well, that's something I want to know about too. If you're about to cure cancer, you wouldn't sell a single share, would you? So, I mean, it's common sense, but something that, you know, like often common sense, the least common sense we have. And it's often a very overlooked edge that I think is a substantial one. The research backs it. It's the same research that the SEC was talking about in their article. You know, Wharton School of Business Studies says investors can reap, by imitating insiders, exceptional profits. University of Michigan insider purchases have abnormal returns. Harvard and Columbia study, which I think was the one the SEC article was talking about, says insiders make market-beating returns when trading before big events are announced. Wall Street Journal, insiders have a persistent edge. Peter Lynch, there is no better tip-off to the probable success of the stock. And I know this sounds like an obvious question, but I mean, who's looking for exceptional profits, abnormal returns that persistently beat the market? Me. It's exactly what I'm looking for. You know, and so the other thing that this gives us, and obviously there's no guarantees in life or trading, but I know that when I used to get into trades or investments early on in my career, I would often buy the stock and then feel terrified about what the headlines would be the next day. You know, so I would often sell my stocks way too early because I wasn't sure if it was just a good trade or whether this thing had guts that could go up much, much, much more. And because I'm not a financial analyst, because I'm not a fundamental expert, I didn't know the answer. And so one of the things I love about the strategy is that I have a much higher level of confidence and conviction when I'm getting into trades that I really like, because primarily, the way that I usually find them first is they have a great pattern. But then I also see that the people that know have put in maybe 5, 10, 20, 30, $100 million of their own money at the same time. And that gives me the kind of confidence to say, I might stick with this one. I'm not going to sell on that 5% pullback. I'm going to give this one room to move, right? And so to me, it is when combined with technical analysis, when you use insiders and that tremendous edge, I believe they give you, that the research supports as well. When you combine that with your as a tool to your technicals, you've got an amazing 1-2 punch, because then you've accounted for the technicals and the fundamentals in the best way possible, right? And that is something I think that's quite special. To be sensitive of time here, I'll show you some examples quickly, but I mentioned pharmaceuticals. If I'm going to take risk in the market, I mean, you can go trade cryptocurrencies, you could go and buy NFTs and have them stolen out of your account. I mean, it's a little bit scary. I mean, that's just stuff you have no control over. As far as I know, I stay away from that stuff. If I want to roll the dice a bit, if I want to take some risk, you know what I'm going to do? I'm going to go and buy a stock in the pharmaceutical space, for example, that has something exciting coming down their pipeline with massive insider buying. To me, that's a risk that I can really enjoy. It's a risk I can understand too. Not because I'm a pharmacist, not because I understand pharmaceuticals, but more because when a pharmaceutical goes well, it can go really, really, really well. So if I'm going to go out there and take an exciting trade that has perhaps some real guts to it, I'm going to go look for something like this, right? Cassava Sciences was one from back in 2019. We alerted this originally that was, I think it was around $1.40, $1.90 when we found it. The director, CFO, president, all buying, right? 177% more in one purchase from one insider for 932 grand. This was a breakout pattern that, for those of you who understand patterns really well, will see then also formed the flag formation. But even in the first move for short-term trades, it was an excellent short-term trading opportunity of about 500% over whatever it was, about a month. But not only can this strategy be very, very effective for short-term trades, but for those of you who also look for long-term, like I do, I usually hold anywhere from 3 to 6 weeks. And if it's not 3 to 6 weeks, it's 6 to 12 months type of thing. It's kind of my two areas that I mostly trade in. So I'm looking for both that. I'm looking for long-term ideas from this and short-term ideas. And the long-term, as you can see here, this is something that these insiders loaded up on and didn't sell a penny, even after it went up 500%. And to do some crazy math, when you see that type of activity, you know, you've got director, this was Sanford Robertson, who bought $932,000 worth of his own money, increasing his position by 177% in that one transaction. So you've got lots of insiders buying at the same time, big percentages and big dollars. So there are websites like Insider Cow, you know, I think was mentioned earlier tonight, where you can go and find that information. The trick or the strategy is finding all of the right pieces to be happening, right? So you're wanting to be looking for multiple insiders buying at prices that are higher or around the same price the stock is currently. But you don't want to see an insider buying at 1 and the stock's at 100, probably missed the boat. So you want to see broad spread buying, heavy buying, big percentage buying. You also want to see that you've got an ideal pattern that gives you the timing piece of when to get in, most importantly, and then also when to get out. And you want all of that to be happening at the same time. So it's kind of a recipe. And to take that one step further, what we also do is when we see that insider buying, we then also go back into the insiders themselves, and we're able to pull a report on any transaction they've done as an insider for the last, I think it's about 10 years. And we see after they've bought or sold any time in any company as an insider over that period, how did it work out? So we'll even look at the insiders themselves and see what their track record is as an insider. And if they buy always at the bottom and always sell at the top, that's going to be very important to see what they do next. And so this is basically a bit of an insight into the recipe of a smart money trade, which is where things start to get exciting, because then now you're going from just an idea to something that's really a robust strategy. And the last piece to that strategy is then to automate it. So when I'm talking about automation, I'm not talking about artificial intelligence or just, buying some algorithm that's meant to go away and make you millions of dollars. I don't think I'll ever subscribe to that. I'm not saying it doesn't work. I just, I want to push that button. And it's easy to push that button, right, when you have rules. And so the last piece to this, and I'm going to show you this in some of these setups, is that in a very volatile market, it's so easy to break your rules. It's so easy to hang on too long, to sell on pullbacks, to get whipsawed out of your trades, especially in markets like this. And we've really been in markets like this, noisy markets, for a while now, haven't we? So it's so important for me to have set and forget rules. What I mean by this is rules that allow you to do most of your trading now, on the weekend, right? Running your scan, looking for where these patterns are setting up, and then pre-programming your entry, your exit, and your stop loss, and letting it go, right? Letting the rules and the system actually do the work for you, because the hard part is figuring out the strategy. Once you know what you're looking for, why you would buy it, why you would sell it, you can automate the rest. You can program that in, and so I just wanted to share with you a couple of text messages from my students in the last 10 days, last 14 days rather, right? This is Ralph. This is guys up from, where is he? Winnipeg in Canada. And again, comment from him from the 25th of January, right? Market's going straight down. And his text to me was, I have so much clarity with Acorn. Acorn has my back. Markets are still going down, and look at me having a coffee in Danish with not a worry in the world. And that is exactly what Set and Forget's about, right? From Harry, it's so uncanny. It's surreal how the charts don't lie. I'm so grateful to have your technical expertise and guidance. Hope we can all meet in the near future and hang out, right? This is not because we have a crystal ball. No one does. But this is because we are following the rules of these high probability patterns. That was a short that we did last year, but we won't worry about that. Same thing here. It's a screenshot from our trading room and look at where the market's at this point. Market's at 4,600, right? 4,600. You can see I've got that head and shoulder target drawn on the screen that this was going to drop to 4,400. This is the call we made to our students at the beginning of the year in January, on January 4th, and we said we believe the S&P, we have a high level of confidence the S&P was going to drop to 4,400. It actually went further than that, but that was our target. And so again, not based on a crystal ball, but based on looking at high yield bonds, looking at the insiders, and looking at the pattern. And so when the market started that decline, we asked our students in the trading room, how does everyone feel about this market turmoil? And the response was, excellent, right? Ready to put more trades on. Well prepared, thanks to your input. Been a good week, puts done well, just fine, most definitely prepared, great to see volatility, saw it coming, amazing, expected the drop, feel great, wish I had started earlier, that's someone who just signed up with our course, but perfect as discussed, it's okay as long as it goes back up. My best trade is one that you recommended. So the setups that they're talking about, to take it one step further, are things like this. NOW, right? NOW, very high probability pattern, being a head and shoulders. The head and shoulders, much like the patterns we talked about on high yield bonds and even a little bit of what we just saw on the S&P, these are one of the highest probability patterns that we look at. There's a lot of patterns out there, but we really focus on a key 4 or 5 setups. And so NOW was a head and shoulder, which is one of the top 4 patterns that we trade. So got a big tick, perfect pattern. Then we looked at, is the pattern occurring at the same time as the insiders, right? Because just because an insider sells doesn't make it a good trade. And again, that's the thing, is that there's lots and lots of websites out there where you can get insider buy and sell feeds, but it's about having the right recipe. What made this the perfect recipe, the combination of all those things to make it a perfect storm, was that you didn't just have this top highest probability pattern being a head and shoulders, but you also had insider selling, and not just a bit of insider selling, but 8 insiders selling as the pattern peaked, with over $47 million of selling happening and a chief financial officer selling 75%. That's what made it special. And that gave us a possible setup, right, for this and this is where the set and forget comes in, to pre-program an entry if it broke below 569 and 75 cents and pre-programmed the target at 515.67 and pre-programmed the stop loss at 592. Now we know that we have a perfect, well, a great pattern. Nothing's perfect. We have a very high probability pattern. We have as good as you can get, as good as you can ask for in terms of insider selling. 8 insiders, chief financial officer selling 75%. All of those boxes were ticked. Now you have also the execution piece. And all of this is done before we even put $1 in the trade. And then we look at our risk and we realize that based on the target and stop loss, we have a 2.4 risk reward ratio. And that ticks the box as well. We've now ticked all the things that I feel we can be in control of, and it all comes out saying, go ahead. So now we just push the button, right? And so that, as you can see, that dropped all the way down to 515 and hit that right on the nose. And if you look at what happened after, it actually rallied back up from there. It's so this is where that set and forget piece is so valuable, and to me, and I know many other of our clients, because when something's going straight down, especially if you're holding puts and you're like, ooh, just made another $1,000 today. Every time you wake up, you're making $500, $2,000, $3,000. It's hard to get out of that everyday paycheck. Easy to give those profits back. And this is why set and forget's important. JYNT, same kind of thing. Head and shoulders, beautiful target. When we found this in our scan, 2 directors, chief financial officers selling $3 million worth. 25%, 34%, and 88%, big selling, right? These are the setups we look for and scour for in the market every day. GRWG, head and shoulders, we found that around $38 as it started to roll back down. And we also found that not only was it a beautiful head and shoulders, but the director, CEO, and president had sold $20 million worth at the left shoulder, and the chief operating officer had sold everything reportedly at which was $5 million worth just a few weeks before, and this stock went from $43 all the way down to recently bottomed around $8. Again, optionable stock, beautiful short. ENPH, another one. ENPH is something that we picked as a short at $248 because we felt that we had detected an early head and shoulders pattern. We were right. So a beautiful setup at 248. And we also found the president, CEO, CFO, chief commercial officer, chief accounting officer, executive vice president, and COO sold $55 million worth at the top of that head. And to us, that's every box ticked. So set and forget, pre-programmed. If it breaks below 243.33, great short. Target 208.33. Stop loss that was lowered when I took that screenshot, but it was just above that entry, obviously originally, and all the way down it went, hitting that target, and then and continuing lower to lower and lower and lower targets. That's stopped out now. That trade is over. But if you actually look at what happened to ENPH yesterday, when it reported earnings, it gapped up to that right shoulder, right around 182. Hit it right on the nose and went straight back down again yesterday and today. I mean, just amazing technicals that are going on in this market. I won't talk too much about longs because we are about 5 minutes behind where I'd hoped to be at this point. So I'll just touch on this really quickly. I know I've been talking a lot about bearish sides to the market, but I mean, but I'm a huge believer in not trying to predict the future, right? If all the things that are making me feel bearish today change next week, then you've got to be ready to be nimble and be ready to be looking for longs. Right, so while I think there's a lot of really important things going on right now in the market with big downside risk, I'm always keeping in the back pocket that my favorite longs, if things were to suggest that now's the time to go long again. We actually traded some longs this week even under the bullish move that we've recently had, and we're able to get some pretty exciting short moves of 10, 15, 20% over 3 or 4 days, and that's exactly what we always have ready in our pocket. But that's where that next stage of things goes, is that whether we recover the bullish side of the market now, or whether we do have another 10, 20, 30% decline in the indexes, that's where the really big money gets made is to the long side, because something can only go down 100%, but it can go up an unlimited amount. So while I've talked a lot about shorts, where my real passion is preparing for whenever that bottom does finally set in, taking advantage of all those amazing buying opportunities that are out there at the moment. So I was going to talk about $0 oil and all these other things. I mean, that was an exciting time. We'll have more of them, but again, I don't want to keep everybody around here too long. So I'm going to fast forward to how you learn this, right? To what the offer is, because hopefully by now you can see this. This isn't just a bright, shiny object. This is a strategy, right? This is about combining not just insiders, not just patterns, but the whole kit and caboodle. It starts by looking at what the smart money indicators are telling us about the market, and then using that to say, okay, should we be looking for longs or shorts, and looking for the trades that have the best patterns with the best insiders, and then using rules to execute. And so my question is, do you think you'd be able to do better if you took these tools and added it to what you were doing, right? It's not an all or nothing situation. It's about having another tool at your disposal that may help you get that extra bit of edge. And that's what I would propose to you, and that's what we're going to offer to you right now, right? So the offer we've put together is our Smart Money Trading Ultimate Bundle, and it is exceptional. There's me with 10 pounds less and a bit of a thinner beard. But our Smart Money Trading Bundle is going to take you start through finish, the foundational skills. I'm a huge believer in giving people not just alerts and what we're looking to trade, but also giving you the why behind it. And so that's why we've included our Smart Money 101 course, which is a really instrumental, tremendous course that goes through the way that we think about things. So we're not trying to get you to unlearn anything that you've learned at the Candlestick Forum or any other place for that matter, but rather go through all of the things that are really kind of critical to our approach, important to our approach, foundational to our approach, such as understanding what indicators we use when we're oscillating versus momentum. What are, out of the 150 plus patterns that are out there, what are the top 4 that we focus on and why? You know, really so that everyone is able to follow our alerts and ideas, or even find your own, working from the exact same knowledge foundation. And then of course the module that finishes off in is module 4, where we go into insider scanning. So this is where we're going to take you through and show you what are the best sites, free online tools that you can use to do the insider research, where you can get the percentages of insider buying and selling, but most importantly, how you can combine that, scan for the right ideas, right, and show you exactly what we look for in our scans. It's not just insider selling, it's a whole bunch of other ingredients that go along with it as well. Same too for the long side. So we teach you the scans, we show you how to run it, it's all set up on a free online tool, and then that's yours for life. We show you how to go back and research the track history of the insiders. So this is not just showing you how we scan for ideas, but it's giving you the why and the pieces behind it, so you can really have a lot of confidence to go out there and be able to do it yourself, scan for your own ideas, or if you're getting into a trade that you found on your own, you can look at you can understand what to be looking for and how to research that behind the scenes. It's an amazing course, and that's normally $19.97. It's 10 hours long, all on demand, and that's included. So a lot of really solid education in that. That's part one. Part two is the alerts, especially in this kind of market. This is where, while you're learning how the tools and some of the skills behind the scenes, this is where you're going to get our alerts, where we'll show you the exact same kind of trades I've just been showing you. All of those ones were alerts, and we give you 5 every week. I do about a 10 to 15 minute video where I'll break down what the market's doing, what high yield bonds are doing, plus 2 other if you liked high yield bonds, you'll love our other 2 indicators. And I break down all 3 of them, because that's the recipe we look at and say, right, what are our 3 systems telling us is highly probable for the next 5 to 10 days? And that's really about the most we look at a month, but not much beyond that. Deal with what's right in front of us and what would be the 5 best ways to take advantage of that. And we'll break down those 5 trade ideas with entries, targets, stop loss, insider information, like what the insiders are doing, and of course and any options we may be considering. We also then follow that up with live training every Tuesday, Thursday at 4 p.m. Pacific. We host a live trading room, which is also recorded. So every Tuesday, Thursday from 4 p.m. to 5 p.m. Pacific, 7 p.m. to 8 p.m. Eastern, and that's uploaded to the portal. So you'll never miss one. If you're busy or have other things going on, those are recorded and uploaded straight away, so you can watch them later or the next day if you prefer. So that's included with the package. Those are both $3.97 in value for the 3 months that's included. And we'll also be including full one-on-one support. So this is for the alerts, the trading room. Those are included for 3 months, and also unlimited support. You can Skype us, text us, screen share with us, email us. Any way that you can communicate, we have available to you, and we're open about 12 hours a day, sometimes longer, and that's a resource you have to get set up right away and utilize as you see fit. And that support's really important to a lot of people who maybe are just getting started. That's included for 3 months. Last but not least, the indicators. I mentioned that there's 3 smart money systems we use. High yield bonds is one, but then we also have 2 other indicators. One that tracks the percentage of stocks in the market that are in bullish or bearish trends in the entire market, and that's integral to this kind of recipe. And the last indicator we use of the 3 tracks the S&P, and this gives us directional signals twice a month on the S&P 500. And over the last 60 years, we've only been using it live for the last 8. We developed it years ago. When we developed it 8 years ago, we back tested it 60 years. It was just under 93% successful, giving us 2 directional signals on the S&P a month going back 60 years. We've been using it in real markets and very turbulent markets for the last 7-8 years, and it's been hitting between 80 and 85% success rate. To me, anything above 65 is a win. Anything above 70 is great. Anything above 80 is fantastic. And this is on the S&P 500. Those 3 indicators you also have access to as part of the program. We teach them to you, and those are all housed in our customer portal. So guys, that is all that is included. Everything is included. And I'll fast forward a little bit here because, again, that package is a $5,788 package if you go out and buy those things one by one from our website. But we have put it together in, I think, probably one of the best offers we've done in a long time. And it's the same offer we gave the Candlestick Forum community last August. We're doing it again today. And the link there is acornwealthcorp.com/value. So you get everything I've just discussed for $397. Okay. I do apologize for going a little bit over time here, guys. And so let me see if I can answer some of these questions for you here. So do you provide alerts? And if so, how often in general? So yes, 5 alerts in general every week. So that might be 5 shorts, it could be 5 longs, it could be a mix of both. But if there is a time where we feel no trade is appropriate, that could also be the case too. And at the end of last year, there was about a 2-week period where I felt the best trade was no trade. And because things looked like they were getting toppy. And I was very tempted to go long. I'll admit that. I mean, I was very tempted to go long, but our S&P indicator hadn't given us a signal yet. And I said to our students, let's wait one more day, then we'll have the indicator on our side. And sure enough, that was the beginning of the drop. And so patience worked out. So on alerts, do you provide the rationale? Absolutely. Yeah. So we'll start. We go top down. What are the indicators? So what's the market indicators doing? And so we'll every single time we talk about alerts, we'll go through the 3 steps. What's high yield bonds doing? What's the S&P indicator saying? And what percentage of stocks in the market are in bullish trends? We'll then look at the pattern on the indexes, like the QQQs, the S&P, the Dow Jones, for example. The Dow Jones right now, as you can see, for example, is in a possible head and shoulders pattern. So every time I do alerts, we'll talk about the key areas to watch, the patterns, the rationale, and then therefore what would be the best possible setups that our scans can find and what we're looking to trade. And then I get all those shorts that I mentioned to you earlier were all alerts of ours. If one purchases this package, what is the renewal fee for alerts? It's $3.97 a quarter. So you are grandfathered in at that rate. Our alerts on their own are $197 a month, right? Normally. For the $3.97 per quarter, you get grandfathered in at that. So past the 3 months, if you want to continue on, you get ongoing access to those indicators, ongoing access to those alerts, ongoing access to your support, the trading room, everything. The course itself is yours for life. So that Smart Money course is, we never turn that off. You'll always have your access to the portal. So you can go through that as many times as you want, and it's already there for you. Please review again what you get for the $3.97. No problems. Let me just fast forward a little bit. Okay, so there it all is on one screen. So it's the Smart Money 101 course, lifetime access to that course. It's, again, 4 modules, 10 hours long, all there for you. 3 months of alerts, right? So 5 alerts per week in video format, written for you in black and white as well underneath the video. So there's no way to miss any details. We don't have to go back into the video and stop. It's also then uploaded to the portal. So you can log into the portal and see all the past videos. And then even when you pull up a stock, you can click on the link and it'll take you directly to that timestamp of the stock of when we alerted it, so you can re-watch the initial alert before it all started to happen. The trading rooms for 3 months, Tuesday, Thursdays, 4 p.m. Pacific, 7 p.m. Eastern. One-on-one coaching for 3 months, and of course the 3 Smart Money indicators, we give you access to those as well, all 3 of them, and that's all included at the $3.97 at acornwealthcorp.com/value. There should be some good kicker signals coming in. Yeah. It's exciting, but you got to respect the market right now. I did start buying some longs that I felt would still go up even if the market go down, or would at least hold their value. But I'm only invested in those with about 15% of what I would normally invest. So 20% of what I would normally invest. So smaller position sizes, but in stocks and tight stop losses, but in setups that if they go well, could really go well. So you'll see some of those tonight. When you log into the portal, you can actually watch those alerts we've just been publishing this week, along with what we see coming next. Okay. I think I've answered all the questions, and I know I'm over time now, so if there is anything at all that I've missed, you can always drop us an email at info@acornwealthcorp.com. There you go. We'll be around here for the next hour if there's any questions that we've missed, or if you have any questions that you want one of our coaches to call and answer. But look, it's pretty straightforward, and it's a great value, and that's why it's acornwealthcorp.com/value. So go there now and get signed up. You'll get all of your access sent out to you tonight. So there we go, guys. Gain-loss ratio, we look at a minimum of 2 to 1, but typically we're looking at 3 to 1 or 4 to 1. Current read of HYG, bearish. We'll probably retest the moving average, but I hate the fact those moving averages are pushing it down. Very bad warning sign for me that says the immediate future is red, dangerous. Until high yield bonds break back above those moving averages, I will be suspicious of any rally. And that's HYG. Okay. Guys, I will finish up there for the night. But again, if you joined this evening, you'll be getting this kind of analysis and alerts for the next 3 months. I would highly encourage you to do it. It's a perfect time to try it. And it's been, of course, an absolute pleasure to be back. Thank you again, Stephen, and everyone at Candlestick Forum. Thank you, Becky. It's been an awesome night, and thank you for hosting me once more.
Thank you, Johnny. Good stuff. Everybody, take a look at this package. This is just common sense, I want to say, indicators that have been accumulated over the years to produce high probability trade setups. So as Johnny was saying earlier, you don't have to use this specifically, but this becomes another strong piece of your arsenal that if you've got this information, you got candlestick information, if you got somebody else's indicators, but Johnny's information is providing the high probability setups with insider trading and all the other indicators that have worked well. He's just accumulated it all into one package. So definitely look at it and take advantage of this package. That's why we like to have Johnny back all the time, because he's got good stuff. All right, everybody, have a good evening. We will see you bright and early in the chat rooms tomorrow. Everybody have a good evening. Thank you, Johnny. Good stuff.
Thanks so much, mate. Have a great night, everyone.